Hello everyone, welcome back. And it has only been a short stretch since markets started sending out another warning flare, but it already feels like every piece of the economy is trying to speak at the same time. Workers are stepping back, health insurance is eating into paychecks, energy is pressing on travel, gold and silver are waking up again, and the conversation around free money from the government is moving from theory to something people are openly debating. Today is Saturday, May 9th, New York time, and before we go any further, comment below what day and date you're watching from. And just before we dive in, if you value this kind of content, support the channel by subscribing and commenting, Our John AG. That one short comment tells me you want more direct breakdowns like this without the noise. So, jumping in, the first thing we need to talk about is not silver, not gold, and not even gasoline. It is people. Because when a country starts arguing about inflation, debt, automation, and currency weakness, but a growing share of men are not even in the labor force, that is not just a labor statistic. That is a flashing light on the dashboard. Now, there is a very important distinction here. You may hear people say that roughly 1 out of every 3 men is outside the labor force, and depending on the age group, that can sound shocking. But if we are talking about men broadly, including older men, the latest public labor data puts participation near the upper 60s. If we are talking about prime working age men, the number is much higher, close to 9 out of 10. So the story is serious, but it has to be framed correctly. And this is where I think a lot of commentary goes wrong. The problem is not that almost all working-age men suddenly disappeared from the economy. That is not true. The real issue is slower and more dangerous. Male participation has been sliding for decades, and after the lockdown era, the recovery in some pockets never looked quite the same. Some men retired early, some moved on to disability, some went back to school, some are stuck caring for family, and yes, some simply checked out. But here's the part people do not want to say out loud. When someone leaves the labor force for a long time, getting back in is not as simple as opening a job app on Monday morning. Skills get stale, confidence fades, routines break, and employers start asking questions. A 6-month gap becomes a 1-year gap. A 1-year gap becomes a lifestyle. And once that happens, the labor market is no longer just dealing with unemployment. It is dealing with detachment. At the same time, the jobs being created are not always the jobs people imagine when they hear that the economy is strong. Based on recently published numbers, healthcare and social assistance continue to absorb a large share of job growth. That makes sense because America is aging, demand for care is rising, and hospitals, clinics, nursing facilities, and home care providers all need people. But the question is, are those roles matching the workers who are sitting on the sidelines? That does not mean men cannot do care work, and we should be careful not to turn this into a lazy stereotype. Plenty of men do excellent work in healthcare, emergency services, nursing, therapy, and elder care. But it does mean the labor market is changing in a way that may not pull every detached worker back in automatically. A strong headline jobs number can still hide a mismatch underneath, and while all of this is happening, employers are staring at another wall, and that wall is health insurance. Family coverage through an employer is now close to the price of a small car every single year. Workers pay part of it, companies pay the rest, but do not miss the point. That cost is real, whether it shows up as a paycheck deduction, a lower raise, a smaller hiring budget, or a business owner deciding not to add another full-time employee. This is why the healthcare discussion matters so much to the labor market. Under current employer rules, larger businesses have to think very carefully about full-time headcount and weekly hours. That does not mean every new worker instantly costs the same amount, because coverage type, worker contribution, and plan design all matter. But it does mean the decision to hire is no longer just about wages. It is wages, benefits, compliance, risk, paperwork, and premiums. And here is the cliffhanger inside the cliffhanger. If insurance becomes too expensive for workers, they drop coverage or downgrade. If it becomes too expensive for employers, they slow hiring or lean harder on contractors. And if both sides feel squeezed at the same time, the official labor data can look stable while the real household economy feels like it is cracking. Now, moving on to inflation, because this is where the story connects directly to gold and silver. People do not need a spreadsheet to know prices are higher. They feel it in the grocery aisle. They feel it at the pump. They feel it when a basic family expense gets repriced and nobody sends a matching raise to cover it. Since the beginning of this decade, consumer prices are up well over a fifth, and that is before you even get into the way households experience specific categories like rent, insurance, food, and energy. So when someone says the dollar is losing purchasing power, they are not wrong. But I would be careful with dramatic forecasts that pretend to know the exact loss years in advance. The better way to see it is this. If wages rise slowly, if insurance jumps, if fuel spikes, and if money supply grows faster than real output, then even a person with the same job can feel poorer year after year. And that brings us to precious metals. Another week, another round of people asking whether silver has already moved too far, or whether this is only the beginning of a larger repricing. Silver recently pushed from the low 70s back toward the $80 area, while gold has been holding near levels that would have sounded impossible not that long ago. But the key question is not whether metals are up. The key question is why they are up. Part of it is fear. Part of it is inflation. Part of it is central banks still wanting gold in reserves. And with silver, part of it is industrial demand. Because silver is not just a shiny coin in a tube. It is used in electronics, power systems, solar equipment, vehicles, and the infrastructure behind the digital economy. As artificial intelligence and data centers keep expanding, people are starting to understand that silver has a real economy story attached to it. But let me give you the counterpoint, because this matters. A rising silver price does not automatically mean the world is ending. It can also mean investors are chasing momentum. It can mean traders are crowded. It can mean some industrial buyers are pulling demand forward because they are afraid of higher prices later. So yes, I remain interested in silver, but I do not want anyone watching this to confuse a powerful setup with a risk-free trade. That said, the setup is still important. If financial markets are being supported by leverage, and recent stability updates show leverage remains something regulators are watching, then hard assets can become more attractive when confidence wobbles. Not because gold and silver are magic, but because they sit outside someone else's promise. A bond is a promise. A bank deposit is a promise. A stock is a claim on future earnings. Physical metal is different. It just sits there. And remember, in past inflation cycles, the first move in hard assets often looked excessive before the public understood the reason. That does not guarantee another surge, but it does explain why serious investors watch the relationship between metals, energy, wages, and money supply instead of staring at one daily candle and calling it the whole story. Now, just before we continue, let me ask you this. Are you buying metals right now, waiting for a pullback, or sitting out completely because prices already feel too stretched? Drop that in the comments, because I want to know how viewers are actually positioning. Moving on to oil and gasoline, this is the part that can turn a financial problem into an everyday problem almost overnight. Based on recent market updates, regular gasoline is back in the mid-$4 range nationally. In some states, it is much worse. And when fuel jumps, it does not stay trapped at the gas station. It moves through trucking, groceries, airline tickets, delivery fees, heating bills, and business margins. This is why the shutdown of a major discount airline matters. It is not only about one company failing, it is about what happens when a low-cost competitor disappears at the same moment jet fuel is expensive and households are already stretched. The cheapest seat in the market often sets the pressure point for everybody else. Remove that pressure, and suddenly the floor under ticket prices can move higher. But again, we have to be honest. Airlines do not fail only because of fuel. Fuel can be the final shove, but weak balance sheets, debt, failed deals, pricing pressure, and years of losses can all build the trap long before the final headline appears. So if someone says energy alone caused the problem, I think that is too simple. Energy exposed the weakness. It did not create every weakness from scratch. And this is the same pattern we keep seeing across the economy. One shock hits, and people act surprised that something breaks. But the break usually started earlier. Households were already carrying expensive debt. Companies were already operating with thin margins. Government deficits were already large. Insurance was already painful. Then oil moves, rates stay high, or demand softens, and suddenly the whole structure looks fragile. Now, what about universal basic income? This topic used to sound futuristic. Now, because of automation, robotics, artificial intelligence, and the possibility of permanent job displacement, it is moving closer to mainstream debate. The argument sounds simple. If machines do more work, people need income. But the math is where the dream runs into concrete. If tens of millions of people received large annual checks from the government, the cost would run into the trillions very quickly. If that money came from taxes, the productive economy would have to carry it. If it came from borrowing, debt would climb even faster. And if it came from money printing, then you are right back to the inflation problem that pushed people toward gold and silver in the first place. Now, I am not dismissing the human side. If technology removes jobs faster than people can retrain, society will have to respond somehow. But a permanent cash system without matching production is not a solution. It is a delay button. It buys time, but it can also weaken the currency, reduce work incentives, and create a new political class that depends on monthly payments instead of opportunity. And this takes us back to the men outside the labor force. If the economy cannot pull people into productive work, and politics responds by paying people to stay detached, then the country may not just have an inflation problem, it may have a purpose problem. Because people do not only need income, they need responsibility, skill, routine, ownership, and some reason to get up and build. That is why the answer cannot be only metals, only politics, only healthcare reform, or only energy policy. It has to be a full picture. Lower barriers to hiring, more practical training, a health system that does not punish work, a currency that does not quietly drain savings, energy that is reliable enough to keep travel and logistics functioning, and a culture that tells young people, especially young men, that their effort is still needed. If you're successful, share your success story in the comments so others can stay motivated. Because right now, people need to hear from those who found a way through the mess, not just from people explaining how bad the mess is. So, as we wrap this up, here is what I am watching. I am watching male labor participation, not as a culture war slogan, but as a signal of economic attachment. I am watching health insurance because it affects hiring more than most people understand. I am watching gasoline because fuel inflation spreads quickly. I am watching silver because it has both monetary and industrial pressure behind it. And I am watching the UBI debate because once politicians discover a new promise, they rarely let it go quietly. If you enjoyed this breakdown, leave a like, subscribe, and comment Our John AG below. Also tell me this, do you think silver is warning us about inflation, or do you think this is just another crowded trade before a pullback? With that said, I hope this helped you make sense of what is happening without falling for panic or false comfort. Take care of yourself, take care of the people around you, and remember, everything discussed here is for education and perspective only. I am sharing how I see the risks and signals, not telling you what to buy, sell, or hold. Your money decisions should be based on your own situation, your own research, and advice from a qualified professional when you need it.